What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring to all of you this evening. So what we're going to be covering in this update is a little bit of the Ortex short interest and utilization data to kind of give us a better understanding of where we're at in terms of if this utilization and cost to borrow data is accurate and what has happened with this short interest over the last 24 hours. Now, going off of that utilization and short interest kind of thoughts where the utilization may not be so accurate right at this time, or we could be waiting to see the cost to borrow start to catch up to the utilization. I've found a couple of things that I think you guys are going to find really interesting, and we could really be in for a big increase in the cost to borrow soon, potentially. And what that leads to is a massive increase for forced share recalls. Now, in addition to this, we're also going to be talking about the options chain going into the end of this week and the max pain. In addition, we are also going to be talking about that key price point where we could potentially see some boom boom candles start to fire off on the charts. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So AMC closed the day at $18.94, down about 73 cents or 3.71%. It's up a little bit in the after hours, but the overall stock market today, mainly the S&P 500, was having an absolutely terrible red day. The fact that AMC was only down 3.71%, I know we want to see the share price start to continue back up to the levels that we're more comfortable with. But when AMC shows strength like this and kind of holds its own, it doesn't have a double-digit percentage red day when the S&P 500 is approaching minus 2% on the day. That is a really, really strong sign. Now, let's get into some of this Ortex data over here. So we have that quote-unquote 100% utilization. We have 1.49% average cost to borrow over here, a max cost to borrow, again, of 2.32%. But when you take a look at the securities lending market, the volume is a little bit lower. Only 553,000 shares were borrowed and 785,000 shares were returned. Now, we typically see these numbers being up into the millions. Now, we also have 21% estimated short interest as a percentage of the free float, 107 million shares sold short, and 116 million shares on loan. So there's a decent amount of shares that can be used against us. Now, we've talked about this a couple of times in the past, but when utilization starts to get closer to 100%, there is a good chance that we do see forced share recalls. We've brought up that research paper from the University of Notre Dame that when utilization gets above 75% for real, that there's a 1 in 26 chance every single day that a forced share recall occurs. Now, what do we need for this to happen? Well, one, you really need there to be not a lot of shares available to be loaned out in the securities lending market. So how can we get a better understanding of what that looks like? Well, we would really need to see cost to borrow start to go up and the volume in the securities lending market start to go down. Because think about this, if there's not a lot of shares out there in the securities lending market kind of sitting in limbo, waiting to go out on loan, the volume is most likely going to be lower. So I want to draw your attention to what we're looking at over here. So this orange line is going to be utilization, and as we've seen a couple of times, it shoots up. Now, we also see cost to borrow lag this number right here where utilization starts to shoot up, and after a couple of weeks, then the cost to borrow starts to go up as well. But what we see is before the utilization and cost to borrow start to go up, the securities lending volume is very, very, very high. Then it starts to fall, and that's the point that we see the cost to borrow start to increase. Now, what have we seen over the last couple of weeks? We saw a wild increase in the securities lending volume on AMC. We saw the cost or the utilization really start to spike up. We've seen a little bit of an inflection point on the cost to borrow start to trend back up a little bit, but now we see the securities lending volume start to significantly decrease, and it could really be time for this cost to borrow to step up. The other thing that I want you guys to think about with this cost to borrow is it's a variable rate, meaning that if I took out a loan of shares and sold them short at 1%, and then let's say a month or two down the line, that rate then goes up to 10%, I now have to then pay that 10% interest rate unless I've somehow found a way to lock in my cost to borrow rate and make it a fixed rate. So this is a really interesting thing that I want you guys to keep a lookout for over the next couple of weeks. It is going to take a little bit of time for this cost to borrow to step up, but we are coming into a very interesting time with AMC. We're going to be having the new Batman movie. We should be getting some more updates about AMC's debt refinancing, and then the big boy earnings. So we have a lot of good things to look forward to. The market is freaking out and AMC is reacting off of that. But remember, just a couple of weeks ago, we were down in the low 14s, and now we've rallied all the way back up into the 18s. We have a long way to go, but that is showing some signs of strength. Now, coming over to Stonko Tracker over here, we only have about 29,000 contracts in the money going into tomorrow. Now, tomorrow is a monthly options expiration date, so we would expect to see a lot more open interest on the option chain, and we're kind of seeing it here, but it's not really anything too crazy. When we come over to AMC's actual options chain, there is a decent amount of open interest at this $20 strike, but again, it's only 22,000 contracts. We've seen a lot more open interest on these specific contracts in the past, and 22,000 is good. If we were to if we're able to close above 20, we would see a decent step up in price action due to the market makers having to come out and buy shares to hedge the calls that they've sold. But again, we need to get to those levels first. Now, in addition to this, we also have Max Payne going into tomorrow at $19.50. So Max Payne, again, is the price where the most amount of options contracts expire out of the money, hurting retail investors like you and me, who are most of the time going to be the buyers of these options on a week-to-week basis, calls and puts, and helping out the market makers, institutions like Citadel or Virtue, who are selling a lot of these options into the market. So $19.50, definitely a price to look out for tomorrow. Now, we do have to get into this conversation about these danger zones again. We are approaching one of them. We've gotten into the danger zone a couple of times, and I want to kind of go over exactly what we're looking at here. So going back to the Ortex data right here, I want you guys to take a close look at the average days on loan of shares. What this is showing us is, okay, so there's a lot of shares out there on loan. How long have they been out on loan? So when we see these significant decreases, these sharp decreases in this average days on loan chart, it signifies that a lot more shares are going out on loan, which also means heavy shorting. So the most recent time that we've seen this significant decrease was right around January 10th, all the way down to January 24th. Now, where was that on the chart for AMC? It was right around, let's see, right here, January, right here. So we saw the price kind of teetering around here, kind of settled down, and then really sold off. So there was a decent amount of shorting in this area. Now, it's right around where we're kind of trading at. We're about a couple of dollars away from really getting into this danger zone. Now, the reason why I call it a danger zone is because these shorts, especially if they've been entering their short positions since November, are pretty green on their position. They're not really going to want to see these positions go red, especially if they are more short-term traders. They're going to want to take some of their profits. So again, those technical traders that we've talked about can easily start to kind of close out their position, and maybe might even want to go long to kind of play that technical rise back to the upside. So we're really looking at a close above 20. That's kind of the average level right there where we see a lot of these shorts entering into to try to push the stock down. If we can blow through there, they go red on their short position. And by the time that happens, we could see the cost to borrow stepping up even more to put even more pressure on these shorts. Now, when we look at the 4-hour chart for AMC, I do still think that we have a solid runway ahead of us, but we do need to see a closing candle above this 200 EMA in order to really send us back to the upside. Again, for those of you guys who missed it in the previous videos, we saw this 1348 cross to the downside back here in November. We fell below the 200 EMA and have not been able to get above it since that November date. Now, if we can close above it, start rallying up, we could get into the next danger zone, which I've shown you guys is around 30, all the way up to another one at around 42. So we really could see the technicals turn into our favor very soon. And honestly, guys, when we take a look at what we're doing with this AMC cause here, yes, I know we all want to make a bunch of money, and yes, we all want to make our markets more free and more fair. But when we're looking at the price action on a day-to-day basis, the reason why AMC and GameStop and a couple of these other stocks have so much potential is that we all know, we've seen it, we've done the research that they are trying to manipulate these stocks to the downside. Now, why would they do that? To spark fear in retail investors. What does fear lead to? Selling. That's kind of why I call those candles, those big red candles to the downside, fear candles because there's a lot of selling going on because uncertainty causes people to make irrational decisions. When we think about this whole AMC situation, especially for me personally, there's really nothing that mainstream media or any price action that we're going to see here that the shorts are really going to try to throw into the stock that is going to alter my conviction. I am in this thing. I'm fully ready for it to go, but I'm also fully prepared for this to take a while to play out. So that is going to wrap up this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next video.